following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Well, greetings. I'm Mike Hurley, Chief Market Strategist for NexPoint with your weekly market deep dive for September 13th, 2021. Starting with commodities, you can see the dollar is continuing to battle that important area of resistance right around 93. You can also see an even more important support down around 90 on these weekly charts in the center of the page. Getting through this area would be important because it could send the dollar back to the top of its range, as you can see on the monthly chart on the left, around 100. And breaking this area would certainly lead to a substantial decline in the dollar and put a wind at the back of commodities. And that is the biggest question facing the markets right now, is whether we are in a reflationary trend or an outright inflationary trend. Looking at commodities a little more specifically, you can see the Bloomberg Commodity Index has seen strong gains since its COVID lows of more than 50% and has been consolidating in a very orderly manner above the 90 area. You can also see copper, which is a very important commodity for global growth, has been strong and has again, the last 6 months, been consolidating just above $4. Finally, on the right-hand side, we have three charts of crude, natural gas, and unleaded gas. And you can see that all three have been strong over the past several months and grinding higher, which do suggest inflation is a real and persistent problem. Looking a little more into the oil and gold markets, you can see a longer-term 5-year look back of Brent crude on the left-hand side. And that has a notable area of resistance right up here in the 75-80 area. We have two contracts on this chart, so it's a little busy. One is the 1-month forward contract and the other is the 12-month forward contract. Regardless, you can see the 75 to 80 area where the 2018 highs were should be an area of resistance, and it is in fact turning out to be an area of resistance. That being said, the 2016 and 17 highs, the 2018 lows and 19 lows are all in the same area, which is in the high 50s. So this area should be support, meaning as long as prices hold above this gray horizontal line, we should assume that the bull market is intact in oil. In fact, if you look at the spread between these two contracts, which is currently $5.19, that is a healthy market or a backward market, and one which suggests higher prices are ahead. So we remain bullish on oil. We do think oil is going higher, and that it could see additional consolidation over the near term. As for gold, we like to look at the spreads between the US 5-year break-even yield and the 5-year actual yield, which is the teal line. We also like to look at the 10-year break-even less the 10-year yield, which is the yellow line. Recently, these two have been diverging, which is a bit of a warning sign. We like to see them a little closer together, but last week both were higher. And this should put a wind at the back of gold, which it has, as you can see by the rising orange line, which is gold in dollars, and the rising blue line, which is gold in euros. That being said, gold is pretty well tied inversely to the 10-year US Treasury yield, which is the red line. You can see that when the red line declines, gold goes up. When the red line increases or when yields go up, the price of gold eases. So we're neutral on gold at this point. Gold should be moving higher with the printing of money. But again, with rates potentially rising, it could put a wind in the face of gold. Speaking of yields globally, starting with the chart on the left, you can see that the US Treasury yield curve is very little changed over where it was 1 month ago. The solid green line is where the Treasury yield curve is now, up to 10 years. And just under it is a dotted teal line or dotted olive line, which you can barely see, showing just how close the yield curve is to where it was a month ago. The dashed green line is where the curve was 6 months ago. And you can see it was a much steeper curve, or a slightly steeper curve, 6 months ago. We're hoping the yield curve steepens with a long end moving higher, which again would suggest healthy economic growth out there in the world. As for yields around the world last week, you can see most of them moved higher. This is a 5-year look back of the German 10-year, the Japanese 10-year, the British 10-year, the US 10-year, and the US 10-year break even. Going back to the lows late last year or early last year, you can see the first of these spreads to move, or the first of these metrics to move, was that 10-year US break even yield. It actually moved higher even as the market was moving lower in early 2020. Following next was the US 10-year yield, which led off the 50 basis point area, followed by British and German yields shortly after. Yields have seen quite a little pullback, but this little bounce test, as you can see as a little W on the chart here, suggests they may have seen a short-term bottom and really are trying to improve across the globe. Looking a little more into the 10-year US Treasury, I would say it was a sneaky or deceptively good week last week. The big chart on top is a daily chart, and you can see that we are just barely getting back into this downtrend channel we have drawn, as well as that purple dotted line, which is a 200-day moving average. The action is far from decisive, however, and I'd say yields are not out of the woods. Before we call that, they'd have to definitely get back above this 138 or 140 area. And you can see just how important that is on the monthly chart on the bottom left and the weekly chart, which we have as the dashed railroad tracks. This area was supported in 2012, 2016, 2019, and breaking it in early 2020 was a big deal. It was an equally big deal to get back above it, but we were unable to hold, and that's where Treasury yields are now. And again, growth in the world, in economies around the world, is usually confirmed with rising commodity prices and rising Treasury yields. So we'd like to see these work in concert to confirm that growth around the globe. As for credit, or the difference between the yield on corporate bonds and US Treasuries, all was very quiet last week. In fact, if you look at the difference between CCC rated corporate debt and the 10-year US Treasury, it was unchanged with a 5% difference. The difference between high yield corporate bonds and the 10-year US Treasury was down slightly, or slightly narrower, down to 3.16%. And the difference between investment grade corporate bonds and the 10-year Treasury were also unchanged, just like CCC's. And they are currently around the 1.08 level. So these yields are near the low end of the range from the last investment cycle, meaning they're definitely not giving us a warning sign on equities. They are, if anything, a wind at the back of stocks. Speaking of stocks, we'd like to start with a 10-year look back of the value line. That's the top pane of the chart. And you can see the value line made a nice low, obviously, back around March of 2020 during COVID. The market has rallied substantially, and over the last several months, built a sideways trading range, or consolidated the gains off the COVID lows. As is commonly the case, when the market marks time, the indicators correct or consolidate, or the indicators correct as the market consolidates. And that's one of the classic ways to work off an overbought condition of the market, is to see the market go sideways and the indicators pull back. The first indicator is the relative strength index, which is a common overbought, oversold indicator. And the blue line is the percentage of stocks within the value line that are above their 200-day moving average. So again, even though the number of stocks above their 200-day has eased significantly from over 80 to around 60%, the value line has not broken its 200-day average respectively. So again, the market is consolidating as these indicators correct. Looking at the daily charts of the S&P and the NASDAQ, you can see last week was indeed what we'd call a pretty rough week, with some significant selling on Friday. The top left chart is the S&P 500. The NASDAQ is the chart below it. And we were hoping to see some additional follow through to the upside last week, and we clearly didn't get it. You can also see market internals remain sideways and really are not confirming the new highs in the indices. You can see it better on the weekly charts in the middle. Again, the weekly chart of the S&P is near the top. The weekly chart of the NASDAQ, where my red dot is in the center, and internals are below that. And what's important is you can see the difference in the character of the market from late last year to this year. Specifically, and please follow my laser pointer here, as the market rallied in late 20 and early 21, the advanced decline line or market breadth on the NYSE and the NASDAQ confirmed the breakout, meaning more stocks were advancing than declining. You can also see more stocks made a new high than a new low in the net new high numbers on both the S&P or NYSE and the NASDAQ indices. That's a very different situation to what we're seeing now, however. The rally over the past several months in both the S&P and the NASDAQ has seen diverging market internals, meaning an advanced decline line on the New York Stock Exchange that has gone sideways, meaning an equal number of stocks are declining compared to those advancing, and is actually starting to form a lower high on the NASDAQ, meaning as the NASDAQ Composite Index has moved higher, actually more stocks have declined since then than gone up. So again, these divergences show a definite weakening in market internals. You can also see it in leadership, in a decline in the number of net new highs and a decline in the percentage of stocks above their 50-day. So all in all, this suggests to us that if there's going to be a pullback in the market or an extended congestion or consolidation range, this is the bearish chance to try and set one of those up. If you look to the right, you can see the Dow Industrials, the Dow Transports, the S&P Mid Caps, and the Russell Small Caps. What was important to us on these charts on the right is the fact that the mid caps failed to break out last week, and the Russell rolled over before even getting to the top of the range. So again, if you're bearish, to not see these two groups break out to the upside and confirm the action in the NASDAQ and S&P was a warning sign. We were not outrightly bearish, however, because again, the markets are still in a cyclical uptrend. And as long as the percentage of stocks above their 200-day average, which is the longer term average, remains above 40%, we think the market's in good shape longer term. So good shape longer term, just poised for a potential correction or consolidation over the near term. Looking at the sectors last week, there was really no theme to the market. All the sectors were down. It was not led by growth names, value names, defensive names, or cyclical names. In fact, the only real theme out there was that a lot of folks were hiding in the fangs, we'll say. If you look at the 4 different style boxes down here on the bottom left of the black table, you can see most of the groups or most of the style boxes were down between 2 and 3%, except for large cap growth. Think Microsoft, Facebook, Google, Netflix, Apple, Amazon. That's where the market seemed to be holding up the best last week. Additionally, if you look at the sectors over to the right and see just how far they're stretched above their 200-day or 40-week moving averages, you can see the only sector that is pulled back to test its 40-week is the energy sector. We've talked about that for a couple of weeks now. So again, if we do see some sort of rotational sector rotational correction over the next few weeks, it would be quite normal to see something like the stretched healthcare sector or the stretched technology sector pull back as things like energy potentially holds this 200-day or 40-week moving average a little more firmly. As for changes in the volatility structure last week, we have the volatility surface from Friday the 10th on the top left and Friday the 3rd next to it, and the difference on the top right. You can see the difference is that the entire curve really shifted up on the week, and that is an indication of that selling on Friday, which made the market nervous, and participants just really bidding up the option prices across the curve. They were particularly bid up in the put side, or the moneyness of around 80, 90, and even at the market. And of course, less so on the out of the money calls. But in general, extra market nervousness as indicated by the entire vol surface moving higher. If you look at some of the individual sectors, as we like to do, you can see oil and gas with that consolidation in crude oil we were talking about, and unleaded gas and natural gas strong. You can see the oil and gas drillers had an actual uptick in the green line, which is call skew. Yes, there was an uptick in put skew as well, but this still remains a pretty wide spread, and it had corrected off its highs several months ago. So again, a healthy configuration in the options market for oil and gas sector. You can also see a change in the green line is now above the red line, the Japanese market, which is a positive shift or a bullish shift. And you can see that both the green line and the red line are above 90% on the dollar. That means put skew and call skew are well bid, which means this is a very emotional market. If you think back to our chart on the dollar a few slides ago, which is at that critical area of resistance at 993, you can see just how critical it is. People are placing bets very aggressively on both sides of the market, and that's often what happens at support and resistance. Should the dollar pop north, again, it would be likely lead to weaker commodity prices and a further pullback in commodities. But yet, should it fail, it could definitely put a wind at the back of commodities, which is what we've seen for the past year. As for the overseas markets, it was a rough week for most of them. As you continue down or look down the center pane here on these weekly charts, you can see the DAX that was off, the ETF associated with the French market, the British market, and a few others were really weak. The only real high point in the overseas markets has been the Japanese market over the last several weeks. The Japanese markets was up over 1% last week, around 5% the week before. And again, this is a major long-term breakout in the Japanese market. As many of you like to know, we like to follow the COVID situation pretty closely, and we like to show the First Trust COVID tracker on a weekly basis. This is published by First Trust. We like to give them credit for the great research piece they have. And again, it's something that will give you a very good handle on the situation in COVID, both in the United States and often around the globe. If you look at the letter A in the top left of the chart, you can see the blue line moving lower and the orange line starting to move lower. The blue line is the 7-day average of cases in the United States, and the orange line is the 7-day average of deaths. So while there is quite a bit in the headlines about the Delta variant being a huge worry, you can see that cases did not exceed the peak from right around Christmas of last year, and deaths weren't even close to the peak last year. So again, while there may be a surge in COVID cases, it does look like Delta is far less deadly than the original strain. Interestingly, if you look at B, the survey up here from the Rasmussen Foundation, they found that as of August 21st, 57% of voters, 57, believe that school shutdowns and business shutdowns or the lockdowns throughout the United States did more harm than good. If you break that out by political party, 75% of Republicans believed that shutdowns and lockdowns were a detriment, and a full 43% of Democrats believe that as well. Pretty high numbers, surprisingly high numbers. Block C shows that COVID fatalities across the globe are quite low. Again, less than 1% for all age groups globally. If you go down to D, you can see the case fatality rate for the United States, which looks to be below 1% to me. The map at point E, or slide area E, is a color-coded map of the US based on school mask mandates. The yellow blocks, which is the majority of the map, have local discretion with mask mandates for children in schools. And the greenish blocks are where mandates are prohibited. The dark blue blocks are where masks are mandated. Finally, if you look at the shaded box to the right near the bottom at point F, this is a very interesting study which found that blood donation samples compared from July of 2020 to May of 21, 10 months later, had a dramatic increase in COVID antibodies. In fact, those samples from July 20, only 3.5% had antibodies from COVID, whereas in May, a much higher percentage of samples had COVID antibodies. In fact, 20% of them from infections alone, and 83% of the samples in May of 2021 had COVID antibodies from either the infection or vaccines. So in summary, if you're looking at the US dollar, you can see the 93 area is of critical importance, which is why there's so many bets going on in the options markets right now. And this market is probably going to go one way or the other in the very near future. Commodities have been strong, rallying smartly off those COVID lows. You can see the 10-year US Treasury really is battling that 140 area, which is a critically important area because, again, global economic growth can be confirmed by strong commodities such as copper and strong interest rates such as the 10-year US Treasury. As for stocks, the character of the rally over the past several months is very different than in late 2020 and early 21. This one is not being supported as strongly by market internals. Again, prior you had a rising advanced decline line on both the NASDAQ and the NYSE, and now you're seeing divergences or weaknesses in the advanced decline line, weaknesses in market internals, and weakness in the percentage of stocks above their 50-day. That being said, there's not been enough weakness in the percentage of stocks above their 200-day, that longer-term average, to really make a bear market call at this point in time. So we believe the market's poised for a potential correction, some potential sideways action, potentially pulling back to the 200-day average, and really digesting the gains over the last year. The risk measures remain strong, such as the copper to gold ratio, the Dow transports to the Dow utility average, the 10-year to 3-month yield curve spread, and the ratio of consumer discretionary stocks to consumer staple stocks. All these remain firm, as does the IPO ETF and even Bitcoin, which is a risk on asset. So again, markets remain good longer term, but over the next few months, we certainly could see some consolidation. I've been Mike Hurley with your weekly market deep dive for September 13th, 2021. I hope to see you again next week.